I think we may be in for a surprise. Investors probably should be continuing to pick up fixed income instruments. Inflation probably has already peaked. It's most likely a monetary phenomenon, as Milton Friedman and Anna Schwartz so very well pointed it out. We had 10% excess money supply growth around 2 years ago. It was in September, October of 2020. Surprise, surprise, 2 years later, we have about 10% inflation, well over the Fed targets. Now money supply growth has been coming down. It's decelerating. We've probably had the peak in year-on-year changes in inflation, and there may be more money to be made in the long-term bond markets. So that's one thing to look at over the next month or so. The second thing is to take into account what you mentioned about an earnings recession turning into or becoming a phenomenon after we head towards an output an employment recession. And there will be signs of that. That's what's brought bond yields down from more than 4% to, let's say, 350 for the U.S. 10-year bonds. It will continue to bring them down, and there will continue to be fears of an earnings recession, but it looks as if we'll get a base from which assets can rebound sometime during the first quarter. And that's because we model this stuff, and it's helped us all the way along this year and in previous years. It shows that the big decelerations are already in place in retail sales, in factory orders, in exports, in durable goods. That's already in place, but they'll tend to bottom most likely during the first quarter. And that should provide a base for equities. The other place to put money has been actually, if you're going to get lower bond yields in the U.S., and put it this way, a surprised Fed. We have seen a surprised Fed before. Imagine 4 years ago, when interest rates, the directed rates were about 3%, the dot plot showed us 3.5 to 3.8 coming over the next 6 months. Well, surprised Fed, 6 months later, actually interest rates were down at 2%. All right, so we may be something like that. Now we have interest rates at 4.2, 4.3. We have dot plots showing 4.8. Let's see where we are in 6 months if inflation is already rolled over and we're heading into really quite a quite serious slowdown over the next month or two.
John, very good morning to you. If the market, and I hear what you're saying about the market trying to form a base in the first quarter, if viewers are watching you now and watching this show and thinking, well, if we're going to form a base in the first quarter, I don't want to miss that. So is there an opportunity for me to buy now at the tail end of the fourth quarter in lieu of that base being formed? Or is that just a bit presumptuous?
It's not presumptuous at all. Everybody has their own investment horizon. Some, it can be 5 minutes or it can be 5 months, really, if you're doing tactical decisions like that. It's perfectly reasonable to begin to take positions now. It's in positions in what and which, because I think a word of caution. We spoke almost a year ago, exactly, just 2 weeks short of a year ago, and we described a sell-off in technology and in consumer discretionary and in the other kind of associated technology, which was communications, Alphabet and Facebook at the time and so on. We don't really want to take big positions in those sorts of sectors yet. And they may be what will prevent the market from rising, okay? You can get a big rotation in terms of sectors and so on in the U.S. market. So that would be one point to look at. Remember, we still are talking about serious slowdowns and dropping inflation, which means actually downward pressure a bit on the prices that they've been able to raise so far.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.